So let's kick off this explainer with a bit of a mystery. Picture this. Somewhere in the US, right now, a 52-year-old is looking at their paycheck, and they are just completely confused. It's smaller than last month's. They've got the same job, the exact same salary, and they've worked the exact same hours. They call HR, but honestly, HR isn't totally sure how to explain it either. So what exactly is going on here?
Now, here's the kicker. It's absolutely not a payroll mistake. It's actually a brand new IRS rule that quietly took effect this year. It's the first rule of its kind ever added to the U.S. tax code. And the truth is, whether or not this exact rule applies to you, the numbers behind it have changed for every single person who has a 401k, an IRA, or an HSA in 2026.
In this explainer, we're going to hit the mystery smaller paycheck, the new 2026 contribution limits, this mandatory Roth catch-up, a quick comparison of Mike versus Sarah, the whole tax now or tax later debate, and finally, 3 things you should check today.
Section 1. The mystery smaller paycheck, caused by a brand new IRS rule.
Listen, if you've got any kind of retirement account, or if you're even just thinking about opening one, stick with me here. Paying attention for the next few minutes could literally be worth thousands of dollars to your overall retirement strategy. And just so you know, every single number we're looking at is pulled straight from the IRS's own 2026 guidance. Moving on to Section 2, new 2026 contribution limits. And the good news here? Every limit actually went up. All right, let's look at the basic adjustments first. You know how every year the IRS looks at inflation and tweaks how much we can stash away in tax-advantaged accounts? Think of it kind of like a parking garage. There's a maximum number of cars allowed inside, and every year, the IRS decides whether to build another level on top. Well, in 2026, they did just that. If you have a 401k, a 403b, or a similar workplace plan, you can now put in $24,500 this year. That is a solid $1,000 more than the 2025 limit. That's the new base limit for everybody. This next part brilliantly illustrates what happens as we get a bit older. Think of this like extra lanes opening up on a highway. If you're under 50, you're just cruising in the base lane. But once you hit 50, an extra lane opens up called a catch-up contribution. For 2026, that extra lane gives you an additional $8,000, which brings your total limit up to $32,500. But check out that bottom row. If you happen to be between 60 and 63, the IRS offers this incredible super catch-up lane of $11,250. That brings your maximum to a massive $35,750 for those 4 crucial years right before typical retirement age. And it's not just 401ks. Your other accounts moved upward too. Traditional and Roth IRAs now have a limit of $7,500, and you can add another $1,100 to that if you're 50 or older. Health savings accounts bumped up as well, hitting $4,400 for individual coverage and $8,750 for families. So that's just inflation doing its job. But buried inside these new limits is a very specific structural change.
Section 3. The mandatory Roth catch-up. This right here is the hidden rule that might actually be shrinking your paycheck.
Okay, really quick refresher before we dive in. When you put money into a 401k, you usually get to choose between 2 buckets. Bucket 1 is pre-tax. Money goes in before taxes are taken out, which lowers your taxable income right now, but you're going to pay taxes later when you retire. Bucket 2 is Roth. Money goes into this one after taxes are already taken out. You get 0 tax break today, but later on, that money and all its growth comes out completely tax-free. Now, for years, if you were making those catch-up contributions we just talked about, you could choose either bucket. So the absolutely crucial point is this specific number right here, $150,000. Starting January 1st, 2026, that choice between pre-tax and Roth, it was totally taken away for one specific group. If you earned more than $150,000 in wages from your employer last year and you are 50 or older, every single dollar of your catch-up contribution now must go into the Roth bucket. It is literally no longer optional. Now, this wasn't some accident or a glitch in the system. Congress built this rule under Secure 2.0 specifically to raise revenue. Think about it. Pre-tax contributions lower what the government collects in taxes today. By shifting high earners into Roth accounts, which don't offer that upfront tax deduction, the government is expected to bring in roughly $11 billion more over the next decade. We aren't here to debate the politics of it. We just need to understand the mechanics of how it actually impacts your wallet. Section 4. Mike versus Sarah. Let's look at a real-world comparison to see how this plays out. So let's say both Mike and Sarah are 55 years old. That means they both qualify for that $8,000 catch-up contribution. They've got the exact same job title, but totally different salaries. Mike pulls in $170,000 a year, while Sarah earns $95,000 a year. Historically, both of them have always just dumped their catch-up money into the pre-tax bucket to lower their tax bill. Well, this year, Sarah's world didn't change one bit. Because she makes under that $150,000 threshold, she can still choose that pre-tax bucket. But Mike is over the threshold. His $8,000 catch-up must go into Roth. Because he loses that pre-tax deduction, assuming he's in the 32% tax bracket, he is paying roughly $2,560 more in taxes today. His take-home pay shrinks, even though he didn't get a pay cut. And there it is. That explains the mystery from the very beginning of our explainer. But wait, here is the twist that honestly almost nobody explains very well. This mandatory rule isn't necessarily a bad thing for Mike in the long run. See, that $8,000 is now sitting in a Roth bucket, which means it grows completely tax-free for the rest of his life. If that money grows to, say, $40,000 by the time he retires, he pays zero tax when he pulls it out. Under the old pre-tax rules, every single dollar of that $40,000 would have been taxed when he withdrew it. Section 5. Tax now or tax later? So is this new rule actually good or bad for you? It really all comes down to a kind of seesaw balancing act. You have to ask yourself, do you think your tax rate will be higher right now or higher later on when you retire? If you expect to be in a lower tax bracket in retirement, then losing the pre-tax option today technically costs you. You're paying today's higher rate on money that could have been taxed at a much lower rate down the road. On the flip side, if you expect to be in a similar or maybe even a higher bracket in retirement, being forced into a Roth might actually be a massive favor. Why would your bracket be higher later? Well, maybe you have a pension coming your way, substantial rental income, large required minimum distributions from your other accounts. Or maybe you just believe tax rates across the board are inevitably heading up over time. If that's your situation, you are locking in today's rate on money that will literally never be taxed again. Now, I do have to throw in a quick note here. This is just general financial education, right? Not personalized financial or tax advice. Literally, no one can perfectly predict future tax laws. Not me, not your advisor, and certainly not anyone on the internet. We are simply explaining the rules as they are written today so you aren't caught off guard when your paycheck suddenly changes. All right, Section 6. 3 things to check today, before the year wraps up. Step 1, check your W-2. Step 2, verify your plan. And Step 3, audit your limits. Let's hit Steps 2 and 3 real quick first. For Step 2, look into whether your employer actually offers a Roth option. Most do now because of this rule, but if yours doesn't and you are over the income threshold, you might be blocked from making catch-up contributions entirely until they update their system. For Step 3, log in and confirm your percentages match the new limits. If the maximum went up to $24,500 but your auto percentage stayed exactly the same, you are leaving valuable tax advantage space on the table. But let's circle back to Step 1 because it's definitely the most critical. You need to pull up last year's W-2 from your employer. You're looking specifically at Box 3. This is your actual paycheck wages, not your total household income. If the number in Box 3 is above $150,000 and you are 50 or older, this new mandatory Roth rule applies to you right now, whether anyone told you about it or not. Look, retirement accounts just aren't something you can set and forget anymore. The rules move, the numbers change, and it is always better to find out on your own terms rather than through a mysteriously shrinking paycheck. So I'll leave you with this question to chew on. If you had the choice, would you take the tax break right now or would you pay the tax today in exchange for completely tax-free money later? Let us know what you think, and as always, keep learning.